First of all, it's always the unknowns that get markets. And I think clearly what happened over the weekend with Saudi has definitely thrown the market for a loop. But to Pete's point, energy, unfortunately, only represents 5% of the S&P. So for folks like ourselves who like some of the energy names, it's definitely been undervalued. And I think what you see today in energy is a reminder there's been a lot of complacency and apathy an energy name for years. And I know sitting down in Texas, we know a lot of these names. They fix their balance sheets. They run a tight ship. The efficiencies that they've been able to unlock, in Texas, Oklahoma, and Louisiana, if this event would have happened just 10 years ago, the markets wouldn't be barely off their highs. And I think this goes to, from a portfolio construction, once again, the U.S. is very insulated. We are now net exporters of oil, and that's a great thing to have.
Yeah, good to have you here today, by the way, timely for certain. You, by the way, Sarat, timely to have you as well, given the interview you just did in Barron's over the weekend about energy, a space you like.
And exactly to your point, it's been so unloved, underappreciated, and it's been one of these, nobody likes to talk about it because it's deep, deep value. And I think to your point, the balance sheets have improved. The sentiment is so negative, and if you talk to their management now, and this is similar to some of the industries that we've invested over in the last few periods. I mean, if you look at the management of EOG, Pioneer, Chevron, they are disciplined, they understand their balance sheet, they want to spend when they have to, and they're looking for capital efficiency. So I think there are opportunities there. Doesn't mean you go crazy and overweight and go 15% energy. It just says at 5% of the S&P, you can pick stocks here that I think will do well.
All right. Doc, what are you watching? Well, what are you watching today? I mean, this is a pivotal week. The Fed likely to cut, I guess, is the prevailing thought.
Absolutely.
Commentary matters. You've got the oil shock, whether it's a real shock or just a 1 or 2 day deal that the markets are going to be dealing with. Markets not reacting all that negatively to that news, even though we're just off the lows of the day.
Right, and it's one of those things, Scott, that we always wondered. And granted, this isn't the same as blowing up a tanker and maybe shutting down the Straits of Hormuz or something, horrible like that. But nonetheless, taking 5% of supply off is a big deal. Traders have always wondered exactly what would happen when an event like this happened. And we saw the spike, 20%, pulled back to less than 9%. Now we're back to about 11.5% gain on the day. But in other words, the shorts that were in there on the crude oil side, Scott, looking for a break of 50 and so forth, were just creamed, taken out, and that was that 20% spike. Now that it's up 11, I've been taking an awful lot off the table, especially with the oil service stocks like Whiting that Pete cite, like Occidental Petroleum. I mean, they bought 10 different oil service or oil stocks going into this aggressively in the last 10 days, very aggressively, like we haven't seen in a long time. And that's with the double-digit short interests out there. So was it shorts protecting themselves, or was it somebody that knew something? I don't know, but I followed it, and I've been hitting the sell button aggressively today.
All right, Dubravko, you come in here 3 straight weeks for the S&P and the Dow. I thought September was, historically a terrible month for the market, and here we are knocking on the door of new highs. How does that affect your thinking about where we go from here?
So I think the market remains in pretty decent shape. You have 2 massive tailwinds behind it. One is global synchronized central bank easing, which in my opinion is actually more powerful, for instance, than what we saw back in 2016 when the Fed was starting to tighten. Now it's also looking to ease. And then 2, we are getting more positive news flow on the trade side. I'm not going to be too hopeful because we've had these false positives in the past, but that's a positive story. I think the big story of the day, however, and I fully agree with the views that were just discussed here, we're looking at a potentially sustained rotation, and we've been on the value side. Energy is an area that I really like. I think that there's a massive disconnect between fundamentals and price action. The short side is massively crowded, and I think there's a pretty attractive risk reward.
I mean, I heard deep value on this side of the table, and I thought of you based on the note that you just put out, a rotation to value from momentum that you think has some sustainability.
Right.
And so I've heard that before, by the way.
No, absolutely. Look, energy can make a case that definitely over the longer run is not going to be a momentum play. It faces challenges and so forth. But we're basically looking at a situation that is significant, like a multi-standard deviation disconnect from fundamentals, right? And so there's a lot of technical forces. And when you get basically things like, basically when you have events like what we saw last week, you get these squeezes on the short side, momentum takes a little bit of a hit, you get this sort of geopolitical surprise. I think it's an area that you at least want to have some exposed in your portfolio. Very orthogonal and a beautiful diversifier.
You're talking about the Fed. The market knows the Fed's going to cut, though, right? Isn't that all in? this point? You expect a surprise this week?
No, I don't. I think our house view is for the Fed to cut 25 bips. We're calling for another two cuts after that. I think it's in the market, but look, the impact on the data and the macroeconomic fundamentals, you will only really start to see 3, 6, 9 months out. There's a lagged effect, but it's a support.